Hello, hello, hello. Hello, everyone joining. I am so sorry for being a few minutes late. We had some technical difficulties as always. We have everyone joining in. I am so excited to have you. Okay, so as we are joining, I am going to go on shared screen so we can get started, get situated, and letting everybody in. And once we have shared screen, I'm going to need all the live energy and action up in the chat. Okay, so as we get that ready, I want you to let me know where you are watching from, right? And also let me know what you're super excited to learn about during the workshop. So those just joining in, let me know where you are from and what you are super excited to learn about in this workshop. And let me go on shared screen. We got California in the house. Okay, Baltimore, Nevada, Pennsylvania. We got people joining in Ohio, Texas. Love it. St. Thomas, Virgin Islands. Okay, international. We got Ithaca, New York, Texas. I am so excited to have y'all here. Orlando. Okay, we're going to get you some help. We're going to do as much as we can during this session. Let me go on shared screen since we were already running a few moments late. We got people coming in. All right.
You're off. What do you want? You
Oh,
smoking a
you want to
cigarette?
make sure we are all muted. I will do that for us as we are getting started. All right. Let's go. Okay, we should be able to see my screen at this point as I go into presenter mode. All right, give me a thumbs up if you can see. You are ready for the credit comeback. Thank you, thank you, thank you. All right, so we're going to be going over strategies and tools to manage your money and stay on top of your credit. So this is going to be a dual session. So yes, we are going to, of course, highlight credit things, but we also want to talk about ways that you can make sure that your money is right, that your budgeting is right, that your strategies are right, so that we can always, always, always make sure that our credit is doing well. I'll get a little closer to the mic, make sure we can hear me well. Okay, so I am Melissa. I am going to be your host today. Thank you, OpenSky, for sponsoring this workshop, right? So as you are joining in, you want to let me know where you are joining from and one thing you're excited to learn about during the workshop. And I'm going to let the rest of the folks in. Let's get back into that chat. All right, we got Washington State, we got Rochester. I love Rochester. South Carolina. We have someone who's living abroad. Okay, okay. And we want to learn how to get that. We don't have US credit anymore. Okay, we'll get it back. We'll get it back. Brooklyn. Okay. I love BK. Natalia said she is excited to raise her credit score. I love it. I love it. I love it. Okay. All right. All right. All right. We have Fraser Park, California. Nice. 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 I love it. I love it. Okay. So here is what we are. I'm a former teacher, FYI. So you will have homework during this session. And we do have a table of contents really to cover all of our objectives and everything that we want to go over, right? So the credit comeback mindset is something we're going to talk about really early on. What is a credit comeback? What does that look like? And why credit matters, why it's so important to have good credit, understanding the credit basics, because there are a lot of myths and errors that kind of get thrown around. We're just like, oh my God, I did this and then this happened. And we don't really understand the nuance of what's going on with our credit. So, what our credit score really means and breaking down that credit score formula. Right. Managing Money 101. I'll give a brief synopsis on my background and then resources, apps, tools, and more, and then the Q&A. So I am a former high school English teacher from New York. I taught high school English for 11 years and I paid off my student loans. I paid off $102,000 in student loans on a teacher's salary back in 2018. And then 30 days later, I bought my first home. So it is really, really, really important for me to talk about financial literacy, to talk about managing money, to talk about budgeting, because it really does make things a lot more effective and a lot more impactful. So as we are letting those folks in, okay, so the goals for our workshop today is to first understand how credit works and why it matters, right? It's not only, oh, credit matters because I need to get a loan, right? It's a couple of more different things than that. Goal 2 is to learn actionable strategies to rebuild credit and manage your money. And then goal 3 is to feel empowered to create your credit comeback and money management plan. All right, so let's get right into what is a credit comeback? And if anything is confusing or if I'm going too fast, please drop it in the chat and let me know. Like I said, I am a former educator, so I like to make sure everyone is keeping up. I like to make sure everyone is staying on track. So a credit comeback is your opportunity to rebuild and reclaim your financial power. So whether you face setbacks, right? So I know someone mentioned the chat that they moved and when they came back, their credit was a little wonky. They didn't have credit anymore, right? If you have late payments, collections maxed out, you are not hopeless, right? So it's not, oh my God, my credit's messed up. I'm never going to improve. That is not what I believe. That is not what OpenSky believes. And that's why we're here to help today. So, a credit comeback is all about starting fresh and taking intentional steps to improve your credit score. And this is your chance to learn more about how to reset and refocus. So, we don't need that, right? So, reminder, your credit score is a number. It is not the definition of who you are. It doesn't mean you are a bad person. It doesn't mean you are bad with money. It just means that you are going to refocus that narrative today in order to improve that score. There's somebody in the waiting room. Okay. Now, why does credit matter? So, of course, yes, if I have a great credit score, then yes, I will get a loan, I will be approved. Those things are true. However, your credit impacts multiple different aspects of your life that sometimes really aren't at the forefront of our mind. So, the first thing, of course, good credit is going to allow you to qualify for lower interest rates, which means it's going to save you money in the long run, right? So, if you're trying to buy a car, if you're trying to buy a home, you will be offered a better credit rate, a better interest rate if you have a higher credit score. It also saves you money over time by reducing the cost of your borrowing. The second thing, which I know often shocks people, let's say you're not looking to buy a home. Let's say you want to rent an apartment. Your credit score is also going to come in handy when it comes to housing and getting a job, which feels like, why does my credit matter with that? Well, the reason or the main reason is your credit score is also a number that kind of highlights or shows your responsibility. So the landlord or the leasing company who is going to look to fill that apartment, they're going to look at your credit score and say, hey, you don't look like you'll be paying the rent on time. That might not be true, but that is what they are looking at. Same thing when it comes to employment, right? So from specific industries, especially in the financial industry, if that's something you're looking into, they run a credit check and they check to see if you have financial credit history, responsible financial credit history. And the next thing that is often underlooked is insurance. So your insurance premiums are impacted by your credit score. That is your car insurance. That could be your homeowner's insurance. I know my homeowner's insurance just renewed in January, and I was shocked to see that they outlined, okay, this is why you got this rate based off of your credit, because it's just like, what does that have to do with anything, right? So they may use credit information to determine your rate. So that's why it's really important to stay on top of your credit, because it's not just, oh my goodness, I'm going to get a loan. It's, oh my goodness, I need to get insurance and I want to have a good premium. Or, oh my goodness, I want to get this job and they're giving me a hard time. Okay. Now, do these numbers mean? There's so many numbers. There's so many numbers. So what we're looking for here, or what we're looking at here, is the range from 300 to 850. So anything from 300 to 579 is rated as per Experian as poor, right? So there's room for improvement. Rebuilding is important to lower your rates and get access to all those opportunities. Anything from 580 to 669 is rated as fair. So you will likely be approved more often than if you had a poor credit score, but you are still viewed as a risky borrower. So that is where you'll have really, really, really high interest rates. Anything from 670 to 739 is considered good. I know a lot of times we're aiming for I want the 700, I want the 800. And of course we want to aim high, but as long as we hit that 670, we're in the good range, right? So 670 and up, we're in the good range where you're seen as dependable and most lenders will approve. When you lean into that 740 to 799, that is going to be very good, where you are viewed by the creditor as a strong borrower and you get lower rates and more options. And then 8 to 850, right? That's our holy grail. That is considered excellent credit. And that is when you're given access to the best rate. So before we move forward, what I want you to do, drop this in the chat for me. Remember, we want to keep high energy. I know it's a Wednesday. I know we have to work tomorrow, right? So what do you think has the biggest impact on your credit score? And how many factors do you think impact your credit score? So it's a twofer, right? So I'll repeat again as we're sharing our answers. What do you think has the biggest impact on your credit score? And how many factors, think of it like a pizza or a pie, how many factors do you think impact your credit score? So what goes in to rating your credit score? Let's see, what do we got? Let's look in that chat. All right, we got a lot. I like the energy in the chat, by the way. All right, so Natalia says 5. Let's see a couple other numbers. 3 factors, 8 factors. Okay, so Angela says late payments. Suzanne or Susan, I don't want to mispronounce, paying off credit cards. Warlock says payment history, about 4. Marcus says past debts. Josephine says late payments. I like the answers coming in. Someone on an iPhone said debt, straight up. Debt, right? Impacts. Okay. All right. What else we got? I got some more. Someone else said debt. Utilization, years of credit history, late payments. Dr. Leah, you're onto something here. I like the way your mind works, right? So let's get to the answer. Okay, so there are 5 credit score factors. Different factors weigh differently. So although we want to think of it like a pizza pie, or you want to think of it as a apple pie, obviously I'm hungry, right? Each slice is not going to be the same size. Okay, so we're looking at this pizza pie. And we see the 2 biggest chunks, the 2 biggest slices on the left are going to be payment history and credit utilization. Credit utilization is the tricky one, so I'm gonna say that one for a little later, like in 5 minutes. But payment history, that's the largest percentage. So even if you miss one payment, that is how serious and strict they take it. If you miss one payment, that has the potential to impact your score tremendously. So one thing that I always say, because I know, and I was talking about it yesterday on Instagram Live with JJ, where we said sometimes we don't want to have the automatic payment on. And I feel you, because sometimes I don't either. I still don't have the automatic payment on my mortgage, even though I've lived here for 6 years. I'm just like, I don't want to press the button myself, right? But we forget. Life is busy, life is hectic. So if you want to make sure you do not miss a payment and impact 35% of your score, you are going to want to put that into your calendar on your phone, or a memo you can put on your Alexa, whatever you need to do in order to remind yourselves, hey, I need to pay this bill on this date. Then we have length of credit history, which is worth 15%. This one is another tricky one, because excellent, viewed as excellent on length of credit history, is 25 years. If you have not been building credit for 25 years, they're never going to say it's excellent. However, the longer you have had credit, the better it will be, right? So because when I was 20 years old, I'm like, oh, I make all my payments on time, but I only had credit for 2 years. So the length of credit history was not so great, but I still was focusing on these 2 big pieces over here to make sure that my credit score was doing really well. Then we have credit mix, which is going to be worth 10%. And that is basically how many different types of credit do you have actively open and that you are responsibly taking care of. So that's going to be student loans. That's going to be any credit cards, a mortgage, any different types of debt that you have, or any type of loan that you have is going to go into your credit mix. And then new credit, that's where we talk about the hard inquiry and the soft inquiries. That's going to be worth 10%. So how many recent inquiries, ignore that typo, how many recent inquiries, hard inquiries do you have? And that is because they want to see how quickly are you going to look up debt or trying to get into new debt, right? So if we're applying for 5 new credit cards in 1 year, that's going to look a bit suspicious to a lender. They're going to be like, why is this person doing this? And now the big behemoth, credit utilization. This is the one that often will confuse people, or they'll say, I closed my credit card because, I didn't want to have bad credit, but my credit score dropped. That would be credit utilization being annoying. And the reason that happens, where if you close a credit card or you used a credit card, but you didn't pay it off completely, but you paid off some, and you're like, my credit still dropped, what happened? That is because you want to try to stay 30% below your entire credit limit. So what that means is if you have 2 credit cards, each credit card has $5,000 as your limit, and you used $5,000 on that one card. So right now, out of $10,000, you've used 50% of your credit. And that's a lot. That is really high, right? So because we want to stay under 30% of our total credit. But now you say, hey, I'm not using that other card. I don't want to tempt myself. I'm going to close that account. So now you close the other card that had the $5,000 limit, but you have that same card, that first one with the $5,000 limit that you maxed out. Now you're using 100% of your available credit. So a really good idea, if I'm not going to use this credit card, I don't want to use it. People joke around, put it in a freezer, right? You could simply just put it in a wallet that you leave at home or put it in a safe place that you're not going to use, but that you're keeping your credit utilization low, right? Because you have that extra line of credit. So those are the 5 factors that go into our credit score and make it look like what it is. Now, common credit mistakes and how to fix them, because like I said, this is our credit comeback, and everybody OpenSky always says, this is your score now, but this doesn't have to be your score in 3 months, right? So yes, we want to point out things that people may get a little wrong, but we want to tell you how to fix them or how to start to fix them. So what is holding your credit score back? Let's take a look at some common mistakes and how you can make your credit comeback plan. Okay, so we talked about late payments. So a couple of ways you can fix that. The first thing is you're going to set up auto pay for at least the minimum. So if you're like, okay, I may not have the money to make an extra payment this month, or I don't have the extra money to do all of these things, you want to have that auto pay on minimum. If you're like, nope, I don't do auto pay up in here, you're going to add your calendar reminder or alarms 3 to 5 days before payment. Now, the reason I say 3 to 5 days is because our calendar rotates, as we know. So that means sometimes it could be a weekend, it could be a holiday. So you want to give yourself time to make the payment and for that payment to post to your account. Because the last thing you want to do is be responsible and make your payment and you're like, oh my God, it was on a Saturday and now it's coming up 2 days late, right? We don't want that. And then the third way is to call your creditor and ask if they can remove a late payment as a goodwill adjustment. So this option works well if you are typically on time. So if you don't really miss any payments, or if this is the first time you miss a payment, because like I said, you're like, oh my God, life got hectic, you can call and ask for that goodwill adjustment. High credit utilization, right? When we're using more than 30% of our total credit score, our total credit available, here are a couple of ways that you can fix that. So you want to pay down existing balances as much as possible. Not all the time do we have the opportunity to pay the balance off in total, right? That is ideal. That is what we want to do. So we don't want to pay interest. But if we're just like, hey, I can't afford to pay, the $8,000 balance, but if my minimum balance is $100, I'm going to pay $150 or I'm going to pay $125. Another way to fix the high utilization is to keep your credit card balance below 30% of your total credit limit. You want to try to aim for 10, but we are human and we give ourselves wiggle room. So you can go between 10 and 30 to ensure that you are keeping your credit utilization low. Another opportunity for you to keep your credit utilization low, and I say this with a caveat, right? You can ask for a credit limit increase if possible. However, that does not mean we increase our spending, right? Because I know it gets exciting if we had a $10,000 limit and now the credit card company says, hey, now you've got $20,000. We're like, oh my God, 20,000, I can spend $20,000. We don't want to do that. Okay, so when you ask for a credit limit increase, what you're doing is you're increasing your available credit. So you're dropping your credit utilization and you don't want to increase the spending, which would then bring the utilization back up. The last way to fix it is to make multiple payments a month to keep your balance low between statement cycles. Now, a really important thing, and again, we spoke about this yesterday on Instagram with JJ, a really important thing that I want you to do, so we're going to write that down in our little homework notebook, wherever. When we are done today, the first assignment that I want you to do is I want you to go into your statement. So any credit card statements, any debt statements, whatever it is, and you're going to write down the 2 dates. There are always 2 dates. There's going to be a due date. That is when you have to make that payment. And then there's going to be a statement closing date. They're usually 99% of the time a different date. Now, why it's important to know the difference. Your statement date is when the credit card company, and I say it all the time, is when the credit card company snitches on you. And in a good way, or it could be a bad way, right? So the credit card company every month says, hey, your statement is closing on March 26th. That means on March 26th, I am going to report to the credit bureau that this is your balance. So if you want to make sure your credit utilization is low, you want to make sure you make a payment before your statement close date. Your statement close date will typically be before the due date. So if my statement closes today, March 26th, my due date may be on Monday, the 30th, I think is the 30th, right? So I would make that payment today or yesterday to make sure that we do not report anything that's really high to the credit bureau, right? So that's something we want to know. Okay. Now, I think somebody wrote on our slides. Money Management 101. Okay. So we want to stay on top of our credit. And that means managing our money because, yeah, of course, we could do all these great things. Yes, we can adjust. But if we don't have a plan moving forward, then we're not going to be able to make sure we're strategizing in a way to hit that 850, to hit that 800 credit score that we really want. Okay. So strong credit starts with strong money management. It's the same way that I paid off those loans on a teacher salary. We all know teachers don't make a lot of money. It took a lot of money management and side hustling in order to make those payments. Okay. So 3 must-have money management strategies. The first thing, so after you check your statement close date and you checked your due date, you're going to take yourself on a money date. And what a money date does is it's going to help you budget with purpose. Sometimes they are uncomfortable. If this is your first money date, you may not enjoy it a lot, but it will help set you up, especially because April starts, I think, next Wednesday or next Tuesday, whatever the days flow by, right? It will set you up for April to have a strategy based off your March numbers so that you go in with the knowledge of, okay, this is how much I bring in, this is how much I can spend, and these are my expenses that must be paid. So a budget is your plan. It is not a punishment. Many times people will pick their favorite budget that they see like an influencer use. Or they'll pick a budget from Pinterest or Google. There are so many options, but if a budget doesn't work for you and your lifestyle and you don't enjoy it, choose a different budget. Choose a different budget. You do not have to use one specific budget in order for you to be successful at budgeting. Okay. So one option is the zero-based budget. This is the budget that I currently use now as like a full-grown adult, I call myself. But when I was in my early 20s, I wasn't using the zero-based budget. It was too much for me. It was overwhelming. I didn't enjoy it. I didn't want to do it. So I used a different budget. And we'll talk about that one in a second. But the zero-based budget, the reason I use it now is one, I have a little bit more discipline and a little more understanding of my money. And 2, I need to know where every single one of my dollars is going, right? So if you are a type A person, or if you also need to know where every single one of your dollars is going, the zero-based budget method is going to be great for you. So at the start of each month or at the end of each month to prepare for next month, you're going to give every single dollar coming in an assignment. Every single dollar coming in is going to have a job, whether it's for bills, savings, debt payments, fun, it doesn't matter, but every dollar that comes into your bank account in April is going to have a job. And what that looks like is your income minus your expenses should equal 0, right? So that's why zero-based budget, right? So for example, if I bring in $3,000, so if I know in April, $3,000 is coming into my account. My rent is $1,200, so I automatically subtract that from the $3,000. Utilities, $200. I automatically subtract that from the $3,000. Then I get to the amount where I can shift around. So I say, okay, I'm going to put $400 towards groceries. That means I cannot go over the 400 in groceries because, like I said, every dollar has a job. So if I spend 401, that means someplace else is not getting the right amount of money that I put aside. Okay. Then I have my OpenSky secured card payment. It's going to be $50. Then my emergency savings fund, I'm going to say, okay, I can put aside $300. And then for entertainment, I could put aside $150, right? So that comes all out of the $3,000 down to $0. But I realized, oh my goodness, I have $700 left after I've put aside all these different buckets. So now I can put this towards goals, right? So I can put that remaining 700 towards an extra debt payment. I could put it towards vacation. I could put it towards anything I want because everything else is covered, right? I can put it towards a buffer for if I go over on groceries, which typically happens, right? So that is why I follow the zero-based budget. But that doesn't mean that is the only budget that can work for you. And that doesn't mean that is the best budget that will work for you. That is an option you have in choosing a budget. Okay, let me go back. Another option you have outside of the zero-based budget is called the 50-30-20 budget. Now, the reason I liked this budget when I was much younger is because I didn't have all of these different buckets. I did not have rent. I was living at home. I was young, right? I didn't have utilities. I didn't have groceries, but I had specific goals that I wanted to hit, right? I wanted to save for a car. I wanted to put money towards college. I wanted to save for vacation with my friends. So I had less buckets to go around. So with the 50-30-20 budget, you put 50% of your income. So same thing, you still need to know how much you're bringing in. You put 50% of income towards your needs. So that means if my $3,000 income is 50% going towards my needs, that means $1,500 automatically comes out. Then you're going to put 30% towards your wants. Why I liked this when I was younger is because I wanted a lot of different things and I didn't have to pigeonhole myself into a specific category the way I have to with a zero-based budget, right? Zero-based budget is a little more stringent. So I said, okay, 30% that could go towards if I wanted to go to a party, that can go if I wanted to go shopping, whatever it is, but that 30% was me to do whatever I wanted with. Then we have the 20% remaining is for saving and debt repayment. So I would split that up. I would put 10% of my income towards saving and 10% of my income towards paying off debt, right? Simple. So every month I knew that is exactly how I would break it down. So we have different options when it comes to a budget. Another option, I know I'm like, okay, we're talking about budget a lot. Another option, because I really want you to do this when we get off the call today. Another option you have for budgeting outside of the zero-based budget, outside of the 50-30-20, is the cash envelope method. You may have seen this around if you're on Pinterest and Instagram and TikTok. What the cash envelope method does is it basically pulls the zero-based budget, but it makes it tangible because sometimes people are like, listen, I cannot have a credit card in my hand because I'm going to swipe, 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 and I'm not going to pay attention. I'm not going to keep track of the zero-based budget. But if I have cash in an envelope and it says $1,200 for rent and I put $1,200 into this envelope, then I know this envelope's only for rent. And when this envelope's empty, I've paid my rent. Same thing for groceries. I have $400 cash that has to last me the entire month for groceries. When that envelope is empty, I know I cannot spend any more on groceries. So that tangible method of budgeting really works well if we know that using a credit card doesn't work, it doesn't help, it doesn't keep you on track. Or if you know, like, oh, I have a little bit of impulse control and, I just swipe or I want to try to get these points. So you want to make sure you use the budget that works for you. Okay, so that's our first step in our must-have money management strategy. The second step is to pay yourself first. You need to prioritize yourself as if you were a bill. Okay, the same way we're like, I gotta pay rent, I gotta pay this, I gotta pay that. You have to pay yourself because when an emergency happens, you don't want to have to rely on putting on more debt onto your plate, right? You want to say, oh, I have my emergency savings, or oh, I have a sinking fund for this, or oh, I have that. But if you do not prioritize yourself in a way that is possible and feasible for your income, we're never going to kind of break that cycle of relying on debt. So what you want to do is you want to automate your deposits to a savings account before you spend on anything else. And if you follow the zero-based budget, you already know every single month how much to automate, right? If I know that I'm putting aside $300 into my emergency fund savings every single month starting in April, that means for step 2, every single month, I'm going to have an automation from my checking account into my savings account of $300. Okay, so this helps create a safety net so you're not relying on credit cards in emergencies. And it also helps you build a healthy financial routine so that you are prioritizing saving and still enjoying spending on other things that you really love. And the third step, again, If we do not like to automate, we still can put a reminder, but you want to set up auto pay for at least the minimum payment on your credit card bills, your credit cards and bills. You can use calendar reminders to review payments and due dates. And because payment history makes up 35% of your credit score, this is the number one way to protect it. Okay, we have to protect where we are so that we can continue to improve, because we don't want to be where we are and slide backwards, right? We want to practice healthy money management to move forward. Okay, money management part 2. So I'm going to recap our homework assignments here because I know, we're going to do them once we get off that call. First thing you're doing tonight, for people who have just joined in, first thing you are doing tonight when we get off this call is you are going to check your statement date and your due date. They are going to be 2 different dates, but you're going to check them because it is super, super, super important that you know, hey, if I want to keep my credit utilization down, I am going to pay before the statement date. Okay. The second thing, you are going to take yourself on a money date. And on that money date, you are going to choose a budget that you are going to follow starting April 1st. So that could be the zero-based budget. That can be the 50-30-20 budget. That could be the cash envelope budget. Or if there's another budget that you know of or that you found online, you can choose to use that one as well. But I always suggest to try a budget for at least 30 days to see how you feel, to see how it works. And then you can decide, okay, I'm going to use something different in May. Now, our next step, so we're on step 3, money management part 2. While you're setting up your zero-based budget or your 50-30-20 or whichever one you'd like, you're going to consider prioritizing the following 3. If you can't prioritize all 3, you're going to do 2. At least 2. Okay? So the first option that you have is a sinking fund. A sinking fund is just a little fancy schmancy finance word for a savings account. That savings account is very specific for a certain expense, right? So it's not your emergency savings. Your emergency savings is for emergencies, but you can have a sinking fund for vacation. You could have a sinking fund for home renovation. You can have sinking funds for a car. You can have a sinking fund for anything you want to buy or spend money on. Okay, so you're going to make that sinking fund and you're going to decide what is the sinking fund for, how much you want to put into that sinking fund, and how much time you're going to give yourself. For example, I love gifting my friends and family during the holidays. It can get a little expensive or it can get so exciting that I lose sight of my budget. Even myself, right? The money expert. Sometimes I can be like, oh, it's not that much. It could work. No. So what I did to tame my own spending around the holidays is I create a sinking fund every January, so the beginning of the year, and I put $80 a month into that sinking fund so that when November, December roll around, I can only use that sinking fund to purchase gifts for my friends and family. That helps, still I can enjoy spending. I'm doing all the amazing things, but now I have plans for the holidays so I don't overspend, right? So you can create a sinking fund. The second option is to create an emergency fund. So if you do not have an emergency fund yet, or you're not really sure how to set one up, this is what you are going to do. Your emergency fund should cover 3 to 6 months of your living expenses. Now, because you are going on a money date as your second homework assignment, and because you are going to choose a budget, you are going to know exactly how much you bring in and how much your expenses are for the month. What I want you to do with your expenses is to multiply by 3 and then multiply by 6. So that's going to tell you how much you need to save for a 3-month emergency fund and how much you need to save for a 6-month emergency fund. If 6 months is overwhelming, you're just like, girl, slow it down. You can just try to save expenses for 1 month. Okay, so let's say your expenses are $1,200. That is how much it takes to cover all of your expenses for the month, which I know is very low. I know. All right, but we're going to use a nice even number. So let's say my expenses are $1,200 and I want to create an emergency fund. So I am going to put $100 aside into my emergency fund every month for the next year. So that means this time next year, I will have an emergency fund to cover 1 month. If I want to put more money, right? If I want to speed it up, I could put more money and then I'll say, okay, if I want to double it, if I want to put $200 a month, I will have reached my emergency fund in 6 months. So you want to make sure you have a certain amount within your emergency fund to cover what it's going to take for you to essentially live or survive for X amount of months. That is your second option. The third option, which shouldn't be an option, but I want you to do it, is expense tracking. It is so unpleasant. It is so unfun. It doesn't have to be. But in the beginning, it's just like, oh my God, I don't want to know how much I spent. I know. And it's okay, right? But you're going to track your expenses to reveal your spending habits, to keep you on budget, to create room to create that sinking fund or that emergency fund, and to prevent overspending. Case in point, back in August, my birthday month, I'm just like, it's my birthday, yay! And I blew my budget. And it didn't feel like I did, right? Because I'm just like, oh, it was just like little small. I just went here, I just ordered this there, and I just did this. And then when I sat down for my money date at the end of August and really calculated and wrote down every single dollar that I spent, I was shocked to see how much I spent at Amazon and Target in August. Over the top. Right. So because I saw that, I then set a much leaner, a much stricter budget for myself for September. Did I punish myself? No. Did I say you can't spend money anymore? No. But in September, I spent much less than I typically spent to help balance out that August spending. If I did not track my expenses and I was just going off of vibes, off of feelings, then I would never know that I overspent. So it's really important to track your expenses, even if it's uncomfortable, even if it reveals like, oh, I'm bugging, like I'm doing too much. You still want to make sure you're doing it to help keep you on track for next month. We can stumble, we can trip up, and that's fine. But we want to make sure we can pick up ourselves to continue to manage our money properly, right? Because we've got goals. We've got goals to hit, right? So one bad month is not enough to throw us off. Okay, so we are almost near the end. We're going to talk about some resources and tools, and then I want you to ask all the questions in the chat that I can address in our last 15 minutes. Okay, so we're going to look at some resources and tools to help build credit from scratch. So for those of you who are like, I don't even have credit, or my credit's so bad that, no one's going to get me started, we're going to talk about that. Rebuilding your credit after some setbacks, and then developing some healthy credit habits. Okay, so if you are starting from scratch, if you're just like, I don't have credit or my credit is shot, you're going to start with a secured credit card. So, what is a secured credit card? That is a credit card that's backed by a cash deposit. So, your credit limit is your deposit. So let's say, okay, I'm going to put down $100. My credit limit is going to be $100. And then you might say, oh, that's not a lot, but we're in rebuilding mode, right? We're in that credit comeback mode. So we're making sure that we're setting the foundation to have that higher credit limit, because in a few months, you might say, hey, I'm ready to do $200. I'm ready to do $300. And OpenSky has different options for you to help grow your credit no matter where you are, right? So why does this work? Why does a secure credit? It's like, that doesn't sound real. It's real. It is real, y'all. The reason it works is because OpenSky reports to the credit bureaus just like a regular credit union, a regular credit card, right? So the same thing I told you from the statements, right? The statement close date and the credit card snitches on you. They're like, hey, Equifax, this person has this balance. So OpenSky will do the same thing for you as well. So that is showing that 35% of on-time payments, and that is going to be building your credit. And OpenSky cardholders see an average 47-point increase in the first 6 months, right? So if you are trying and you're working, you're like, I really want to see some movement, I want to see some progress to keep me motivated, this is a great first option for people who are starting from scratch. Okay, now there are benefits to the 3 different types of card options. Like I said, wherever you're starting on your journey, whether you want to start with $100, $200, $300 deposit, there are different benefits. So just like a regular traditional credit card, okay, you can get up to 10% cash back rewards. I love rewards. I love cash back. There's a mobile app. They have monthly reporting, zero fraud liability, everywhere Visa is accepted. And you also get a free online access to your FICO score, which is extremely important that you're monitoring the progress, right? So what am I doing? Is it working? How can I continue to do that? How can I modify? All right. Another option you have outside of being having a secured credit card is also becoming an authorized user. Now, when you become an authorized user, you want to make sure of two things. You want to make sure one, it's of a friend or a family member that you trust and that they trust you, because you both are going to kind of be impacting each other's credit score. So the benefit is their good credit behavior helps build your credit profile, but you also need to exhibit really good credit activity to prevent hurting them and to also continue to build yours. So if you're like, okay, I have my OpenSky secured card, but I still want to keep continuing to do things to work on my credit comeback, you can seek a friend or family member that you trust and ask to become an authorized user on one of their credit cards. Another option you have is to take out a credit builder loan. Now, if you have never heard of a credit builder loan, I really like them when it comes to having a secured credit card and also having a credit builder loan, because here's what it does essentially. It's a small loan where payments are held in a savings account until fully repaid. So it kind of works backwards the way a loan works. So when you take a regular loan, you're like, okay, I need $5,000. The bank says, okay, here's $5,000, but you need to pay back over this amount of time. What a credit builder loan does, they do it in reverse. So with them, you give them the money, excuse me. You're paying those payments first. And once you have paid the amount, then they give you the total, right? So if you're like, okay, I need $5,000, they're going to say, all right, you're going to pay us $200 a month until you hit 5,000. And once you hit 5,000, we'll give you that $5,000, right? So this way, it's like, oh, I've already paid. There's no way for me to really default on this loan. Okay, another option, because we're all about options here, right? We like options. You want to use rent and utility reporting services. So services like Experian Boost allow you to include on-time rent and utility payments in your credit history. So this is something that's so important because a lot of times people were like, well, I pay my rent all the time or I pay my electric bill all the time, but that doesn't matter. That never goes towards, like my credit responsibility. And now it can, right? So we want to make sure that we're using all the different options to help build that length of credit, to help build that payment history, to help build that credit utilization in all different aspects. Oh, I'm going to let somebody in. Okay. All right, here is your goal, and then we're going to open up to Q&A. This is your credit comeback plan. Your 30 days, the startup, right? We're just getting started. You're going to pull your credit reports from all three bureaus because you want to see where you stand. You want to know exactly where your credit score is, and you want to review for any errors and dispute any inaccuracies. That happens, right? Where you think, hey, my credit should be higher than it actually is, but you see that it's lower, and it's because there might be an error on there. So make sure you look through to make sure that everything is correct. You're going to apply for an OpenSky secured credit card, and then you're going to create your zero-based budget. If you choose, I don't really want to do zero-based, you're going to choose a budget that works for you, right? To manage your spending. So this is what we're going to do in our first 30 days. I already gave you the homework when you get off the call, but first 30 days. Then as we proceed, right, in your next 30 days, you're going to keep that utilization low, under 30%. You're then going to automate or put a reminder in your phone, payments for your credit cards and bills, so that it takes one thing off of your plate so that you don't have to continue to do, oh, I need to remember this, I need to do that. Next, you're going to start or grow your emergency fund. We already have that framework going, right? We have that momentum. Monitor your credit score's progress monthly and review your budget and adjust for any changes. And then now, as we're gaining momentum, what we want to make sure we're doing is we're going to continue making on-time payments, and we're going to increase our savings goal to aim for at least $500 or $1,000 in our emergency fund. Then we're going to consider requesting a credit line increase, right? Because we're doing really well. We've got our OpenSky card. We're making our payments. You want to think about whether you want to increase that limit. So if we're at 100, maybe I want to go to 200. Maybe I want to go to 300. And most importantly, after you've been grinding and working so hard for those 3 months, celebrate your wins. Celebrate what you have done, how far you've come, share your progress with the Credit Comeback community. Of course, you want to follow OpenSky on Instagram. They are full of so much information that you can, follow, but also you want to make sure that you are celebrating yourself. And of course, OpenSky wants to hear that celebration. Okay, So I'm going to come off share, but before I do, you want to grab your phone or any digital device and head over to any of the QR codes to learn more about OpenSky, to connect with me on Instagram, or to join the Future Millionaire newsletter, whichever you would like. I want to thank you so much for joining me. I definitely want to keep in touch. And now, as I come off of shared screen, you can drop any questions you have in the chat. I will go through as many as I can, as quickly as I can. I know we're like a smidge over. All right, let's come off share. We have a couple people in the waiting room. And let me go into the chat. Oh, keep dropping those questions. Keep dropping those questions. All right, let me go all the way up. Okay. Will this recording be available after? Absolutely. You will get an email in 48 hours with the recording of this video with a link. So do not worry if you popped in late or you had to leave early. You will get a copy. What about if okay. What about if your income fluctuates weekly? Would you do a money date weekly or would you plan a budget on your minimum wage? That is a really good question. It's an iPhone, so amazing person. So that's a really good question. So what I suggest you do, two options, we all about options. First thing, if you feel comfortable going on a weekly money date, if it does not overstimulate you or frustrate you, then I suggest you could do weekly to prepare for the next week. So that could look like Friday or Saturday. You're like, all right, I'm gonna get a pizza. I'm gonna go on my date. I'm gonna look at what I spent this week. I'm gonna look at how much I made this week, and I'm gonna estimate what I'm going to make next week and how I'm going to change my expenses. Another is too much work. What you can do is instead do an estimate of how much money you bring in on average per month. So yes, it might fluctuate, but what is the average? And then you would use those numbers as your monthly money date. So whichever you feel most comfortable, whichever feels most accurate for you, that's the route you want to take. But very good question. Okay. Okay, so what is the best strategy for when you are at 747 and every time I go up 757, it goes up, and I think it's like, what happens if your credit score goes up and down? I think that's what the question is asking. So essentially your credit score is going to fluctuate. Sometimes it'll fluctuate during the month, and that is typically because of credit utilization. I wouldn't worry too much about a 10 score going up or down. If you really are going and going and going for that 800 credit score, I would focus mostly on keeping my credit utilization down and then on-time payments, because everything else will kind of adjust itself. So length of credit history, every year that you have credit will be a positive. Like I said, for me, it was so aggravating. I was doing everything right, but because I only had credit for like 4 years or 5 years, my credit utilization, my length of credit history, I couldn't do anything about that. So the longer you have credit, the more times you pay it on time, the lower you keep your credit utilization, the closer you can get to that 800. But if it's going up or down 10 points, that's pretty typical and pretty average. Like I said, it's just based off of what they're reporting at what specific time. Someone asked, can I recommend any good debt consolidation companies? Unfortunately, I don't know any off the top of the head. I would say speak to a fiduciary, fancy finance word. A fiduciary is anyone in finance who essentially has your best interest at heart in order to guide you to properly manage your money. So if you do your research, you Google, you're like, I have no idea. I would definitely speak to them as a way to kind of guide you into a really good debt consolidation company. But unfortunately, I don't know any off the hand. I love this question. How can I become more disciplined and tell myself you have food at home, or do you have XYZ money? Money burns holes in my pocket. I am MCP. I don't know your full name. Heard you, understood. So discipline takes time, but I think what happens where it's like, oh, I'm not, it's either this or that. That's because we're punishing ourselves. So what I would suggest, and I do it for myself, is to add a byline in your budget for yourself. Now, what that looks like, it's gonna look like different for everybody, is let's say I do my zero-based budget at the end of the month, I have $300. I'm going to take $100 and that's going to be for myself. That's going to be for any and everything that I want to do up to $100, right? And you could change it. It could be 50, it could be 200, whatever it is, but you need to put yourself in your budget, because if you don't, you will feel like I don't have any discipline. I don't have anything. You're not giving yourself the wiggle room. You're not giving yourself the grace. So I highly recommend, if you're like, I have food at home, yes. So you can eat at home 5 days a week. And then 2 days a week, you can eat out, get your favorite meal, but it would be within the parameters of whatever money you set aside, whether that's $50, $100. But now you're not punishing yourself. It's actually like a reward, like, oh, I ate at home 5 times. I now get to go out and get pizza. That's what I do for myself, especially when it comes to Sephora and Ulta because I love it in there. I give myself $150 and sometimes it's less depending on what I'm saving for. I'll give myself $150 for the month. And I'm like, you could go crazy in Sephora Ulta for 150. And when that 150 is done, exit, right? So you really want to give yourself the opportunity to enjoy your money on that budget. That's really the best way to do it. So do it. MCP, you got time. You gotta wait. Sierra, is it better to inquire Sorry, is it better to acquire a loan to increase your credit or a credit card? Good question. So this is going to really be based off of essentially your financial goals, but what I will suggest is that you think about both ends. So if you are getting an increase in your line of credit, that's not going to be a hard inquiry. And that is going to help for your credit utilization because now you will have more available credit. However, if you're like, okay, my credit mix, right, which is another 10%, I don't have any credit cards. So I want to open a credit card to add to my credit mix. That may be the path that you choose based on what you're trying to do with your credit or your financial goals. Sometimes people are like, I'm going to do both. But you want to remember if you open up a new credit card, that inquiry, that hard inquiry is going to stay on your account for 2 years. So if you're like, okay, I'm going to do this year and I'm going to purchase a house in 2 years, that's fine. But if you're like, oh my God, I want to purchase the house in 6 months, you may just want to go the route of getting a line of increase instead of opening a new credit card. So it is very based off of what your financial goals are, short term and long term, and what it is that you're aiming to do with your credit score. Very good question. Okay. Um, we answered that one. Okay, so I always heard 10% utilization is best. Can you please explain if it makes a major difference if you pay your bill prior to statement end date or payment due date when you're only using 10% or less? That is you guys come through really good questions. So for me, this is the response for me. I like to pay before the statement end date, no matter if I'm using 10% or less. I don't like paying interest. I don't like paying extra money. If I bought a pack of gum, I don't want to pay more than the price of the gum. If I bought whatever it is, I want to pay the price is the price, right? So if you're just like, okay, I have the money to pay this off before the statement date, I would suggest just paying it off so you don't have to pay interest and your credit utilization can be zero. It's even better than 10%. It's at zero. So if you have the funds, you want to just pay it off. Yeah, so I took out a loan through Credit Karma. It's a line of credit that's locked. It's called Credit Builder. Yes, I think we got to that when I got to the resources. A Credit Builder loan, it's really great because essentially, like I mentioned, it's a traditional loan in reverse. So what it is that you pay the payments before the bank or the financial institution gives you the money, and it's reported as on-time payment. So that's really great because it's impacting that 35% of your credit score. I like the clarifying question though. What is the best way to handle collections? So we spoke about this in our first one in January, which if you did not see that webinar in January, I will link it in the replay as well so that you can have access to both. But essentially, when you are handling collections, you want to have all your information ready. You want to have any inaccuracies, anything that's correct, whatever it is, because you're going to need to have phone calls, emails, all of that documented, and you essentially need to present the cause because what you can do is negotiate. So what they'll say is, hey, you owe $50,000 and you may want to respond like, hey, I can pay you $30,000. Be sure whatever you say you can pay is what you can pay because then they might say, okay, yes. They'll take that 30,000 and then you no longer have to deal with collections. So you want to make sure you're able to negotiate, but you want to have documentation and everything ready. Like I mentioned, I want to answer a few more questions, but like I mentioned, if you do want to learn how to handle collections on a more like slower conversation than me speeding through, I will link in the email to the first OpenSky webinar from January because we spent a little bit more detail and like went through like a script of things that you can say. And that one, like you could save that replay as well. So I got it for you. Okay, we'll do two more questions. So when you have increased your credit score, how do you get your money back? So essentially what you would do is you could essentially close the account, but like I said, you don't want to close your account. OpenSky has a ton of different options for you to go into an unsecured card, right? So if you're like, okay, my credit is up, the secure card, like I'm good, you could essentially pivot into having a unsecured card with OpenSky. And if you head to their website, so it's OpenSkyCC.com. If you head to OpenSky's website, they can tell you a lot more about what you can do essentially to graduate onto a secure unsecured card. Okay, let's do one more question. So someone said, pardon, any question or any advice on how to handle charge-offs? I don't want to rush through that answer, but like I said, we spoke in detail on collections, charge-offs, things like that, how to handle it. We have scripts on the deck. If you go to that link, which I'll be sharing in 48 hours, so you'll get this replay here, and then you'll get the replay from January's webinar, so that at least you can like pause and write it down. But if I feel like if I rush through in our last 2 minutes, it won't be helpful for you. So I'm not brushing off your question. I just want to make sure that you have all the details you need in order to, do it properly. Last question. Okay, so Marcus says, what to do about student loans? Are they treated differently? Student loans are treated differently in many different aspects. But one thing that I will say when it comes to student loans, it's the same thing with a mortgage and the same thing with a car loan. When you pay that off, that is going to close because it is not revolving credit, right? So there's no way. So like with a credit card, if I pay off a credit card, I can keep that credit card open and keep that line of credit in order to maintain like length of credit history, credit utilization. But with student loans, once you pay them off, and this happened. So my student loans were my first credit. My first line of credit was my student loans. When that closed, when I was at 20, whatever, it did drop my score. And that is because it impacted very little. That is because I had that account since I was 18 and it was my oldest account. The next one I opened was in 2015. So I had an account from 2007. I know I had a student loan open from 2007. And when it closed in 2018, my score dropped because my first like credit card was 2015. So it does happen, but student loans are treated a bit differently. They still impact your credit score, of course, but they're treated a bit differently because they're a different type of debt. They're not revolving debt. So it's same thing with a mortgage, same thing with a car note. If you pay a car note off, the account will close. It might drop a little bit, but remember, that's only 10%. The most important part is if you were making on-time payments for those student loans, on-time payments for that car note, you're impacting 35% of your score, which is much more important, which is a much bigger piece of the pie. So those are the things you want to focus on when it comes to building credit. I hope I covered that. Okay, that is our time. Thank you so much for joining me on a Wednesday night. And I hope to see y'all on the internet. Please look out in your inbox in the next 48 hours for a link to the replay of this webinar and a link to the replay of the January webinar. And I'll see y'all on the internet. Thank you so much for joining. Have a good evening. Bye.